Hi, and welcome to the January buy-to-let mortgage market update. My name is Richard Purnell. I'm from the Mortgage Home, and we are your buy-to-let mortgage specialists. So, 2023, what have we got on? We're going to start, as usual, with a focus in on interest rates. As you know, the Bank of England put the interest rate up by 0.5% in December. It was the 9th consecutive rate rise. And if you've got a variable rate mortgage, you will be well aware with those letters coming through the post thick and fast with the new mortgage payments. It's the highest rate we've had now for 14 years at 3.5%. A little bit of silver lining. Well, temporarily, maybe we will have no rate rise in January. How do I know that? Well, only because the committee from the Bank of England are not meeting until February. So we've got a little bit of a grace period. But I want to talk a little bit about inflation. Why is that important? Well, the Bank of England are tasked with one, frankly, major job, and that is to keep inflation at a certain target level. And pretty much the only tool they've got in their box to do that is the use of interest rates. And that's why we're so interested in what on earth's going on with inflation. So I've put on here, as it peaked, that's because it did get up to 11.1%. And it's now dropped back to 10.7. Is it on the turn? Well, look, you're not going to get me to commit. I'm not an economist, but it does appear that it is on the turn. Let's hope so. So does that mean the end of interest rate rises? Well, sadly not, because the target for the Bank of England is to get inflation right down to 2%. So because we are so way off there, I can say with some certainty that the Bank of England will be putting rates up later on this year. So what's my prediction? Okay, well, let's get the crystal ball out. I would say that if we split the year into quarters, in the first quarter of 23, we might see up to a 0.5% rise. In the second quarter of 23, perhaps up to another 0.5% rise. So therefore, in the first half of the year, I would say somewhere between 0.75 and a full 1% rise on the Bank of England rate. Now, if that does its job and inflation continues to drop, then I would see that the Bank of England might take the foot off the gas and in the second half of the year, leave rates alone. Oh, very interesting, you say, but what does that mean for mortgage rates? That's far more important than what's going on with the Bank of England rate. So, look, if you're on, as I said, an SVR, you're on a tracker rate, then you are really linked to the Bank of England rate, and that's obviously been affecting you. But here's the thing. In December and in January, we're recording this on the 8th of January, I'm now seeing mortgage rates actually starting to drop. Now, this appears to be a contradiction. Everything I've just said leading up to this point has been about rate rises. And now I'm saying that mortgage rates appear to be slightly dropping. So, Richard, what's going on? Can you explain that? Well, if we focus in on a category of lender that are not the banks, and if you're a portfolio landlord, you're unlikely to be knocking on the high street banks' doors for your buy-to-let mortgages. So you're going to the secondary type of lenders, your Kent Reliance, your Kensingtons, Precise, Paragon, Aldermore. You know the guys I mean. So these guys tend to get their wholesale money, their tranches of money that ultimately they're going to dissect and lend out as mortgages from financial institutions. So these buy-to-let lenders tend to use something called swap rates as a pricing mechanism, not the Bank of England rate. So swap rates are essentially an interest rate that the institutions calculate for the medium to longer term situation. So 2, 3, 5, 10 years, in line with the sort of fixed rates that you might see out there. And it's the institution's prediction of where interest rates are going. And these swap rates, although they spiked in October and November, which is why we saw mortgage rates increasing at such an exponential rate, even though the Bank of England rate didn't go up at that point. Now, because we've got more certainty with a change of government and change of Prime Minister, budgets being reversed, etc., etc., talked about it at length in November and December. Because there's far more certainty with the institutions, these swap rates are now starting to drop. And therefore, these secondary lenders can start to pass on some of that saving in mortgage rates. And that's why we're now seeing mortgage rates start to drop. How much, Richard? Okay, let's not get too excited. We are not going back to 2, 3, 4%. I'm seeing rate drops of 0.1, 0.2, 0.3% perhaps. You're in that sort of region, less than 0.5% drop. Look, we take what we can get, won't we? So that's the good news right now in terms of mortgage rates. So having a review of your situation right now in January, I would say is not a bad time at all, because you might be able to grab those slightly lower rates. And when it comes to that, if you are tied into a deal, and let's say you've still got 6 months redemption penalties left, that's a really good time. If I were you, that's when I would be engaging with a broker, even though you've got that 6 months, because if you are needing to refinance, let's say your existing lender doesn't do product transfers, for example, so you have to refinance to somewhere else. Let's say you also want to capital raise. Then if you engage with a broker now and they can get you a deal at those January rates, then they could get you to a mortgage offer on that new deal and park it for usually up to 6 months. That allows your redemption penalties to come to an end, and then we can move you across, but we can get those rates as at sort of January. So be proactive and engage with your broker is my message there. If you are looking to speak to any of the team, then there'll be a link at the end of this piece to our diary. Do put yourself on. It's completely free, completely no obligation. Have a chat with the team and let's see if we can help you. Okay. Given that it is January, what I also wanted to talk about today is what do I see as the big challenges for landlords this year? So I've picked out a top 3 areas that landlords should be concentrating on. So refinancing, I've hinted at it on the a little earlier. We've got about 2 million fixed rate mortgages coming to an end in 2023. So there's a spike of fixed rate mortgage coming to an end. A lot of them are 5-year fixed going back to 2017. So of course, back in 2017, interest rates would have been 2, 3, 4%. And you 2 million people are going to be hit with rates of probably 5, maybe 6, and in some cases 7%. So in other words, the rates are doubling as you're going to come off your fixed rate. And of course, rents have not had chance to catch up. Rents are going up at quite a rate. I've seen in London, in fact, in inner London, I've seen now that rates are averaging around a 20% annual increase. But more generally, we're talking about a 10% plus increase across England, generally speaking. But even at that rate, it's going to take some time for the rents to catch up and be more in line with the mortgage payments. So refinancing now is an issue in the short term. So again, my message here is be proactive, speak to your broker about what those options are. Stress testing. I'm not going to go into what that is in any detail. I covered it in the December market update. So do refer back to that if you want to understand that in a little bit more detail. But again, because of the significant rate spike back in September and October, we have this issue, of course, as I've just said, that rents are not covering the new payments. If you're looking to purchase a property, for example, particularly if it's a family-let property, yields have never been that high on family lets. They're bread and butter properties, steady away, longer term. They were going to go, they'll give you some sort of cash flow, but they're never high yielding. Well, now these are the ones that are suffering. So if you're buying a family-let property, if you're looking to refinance a family-let property with a high leverage, high LTV, if you're looking at equity release on family-lets, then you're going to have an issue right now because of the stress test. What we want to see, and what I'm really hoping, is that lenders will be more innovative in 2023 because they're losing business. If you can't refinance, if you can't buy your buy-to-lets at the same level, then these secondary lenders, they're going to suffer. They've got to get the volumes in, so they're going to have to think of ways around it. There's already some tools that brokers have got in their box, in their armory. 5-year, if you take a 5-year fix, then the formula on stress tests are a lot more flexible. So that's one thing to bear in mind. And there's something called top slicing, which again I've covered in earlier videos, which if there's a shortfall with the rent not covering the mortgage payments, there are a number of lenders that will look at your personal disposable income and allow that to supplement the rent. And I really hope and maybe predict that more lenders are going to widen those offerings this year, because otherwise that is going to be an issue. But that is one of the challenges for you guys as landlords. And the last thing, it's been around for a while, but it's gathering pace, I'm afraid. I haven't talked about EPCs for a while. I think it was last July I did a whole hour on EPC. So if you really have been, you don't know what I'm talking about at this stage, why is it an issue? Do look back to my July update, when I spoke to a specialist EPC surveyor who gave a lot of fantastic tips about what you needed to do, what's on the horizon, what are the challenges when it comes to that. In a nutshell, the government are looking to, it's not statute, they've not signed it off yet, it's at consultation stage. But in 2025, 2 years away now, are looking to say that the minimum EPC rating is going to be a C for any new rentals. So that could well mean that you're unable to rent your property in 2025 if you've got a D or an E, or for God's sake, an F rating on your buy-to-let right now. So here's what you should be doing. Write this down if you've not done anything about it. Assess your portfolio. What are your EPC ratings? Are they up to date? They've got a 10-year lifespan. Has it run out? Get it renewed. Look at your EPC certificate, and it will, if it falls short of that C, if it's a D or an E, it will say, there'll be recommendations about what you can be doing to bring it up to a C. What it doesn't say is what the cost is. And clearly that's the crucial for your decision making. So look into that. Make 2023 your year when you're going to start to go through your portfolio one at a time and assessing what needs to be done and whether you're going to invest in it or you're going to sell. Because literally, if you're going to sell because it's too much to bring it up, then you should be doing that sooner than later. We do not want to wait till 2025 and then there's a glut of buy-to-lets coming on the market, because there's apparently over 3 million properties that are going to be affected by this in the private rental sector. 3 million properties. Aldermore did a survey in November, December last year of 500 of their landlords. 60% of them are making it a priority this year to invest in their properties to bring that EPC rating up. Take a leaf out of their book and start work on it this year. There are more lenders starting to offer preferential rates for further advances, for additional borrowing. They're offering better rates than if you're coming to them as a new customer. So the lenders out there are trying to help a little bit more. And again, if you want to know more information, again, there'll be a link to our diary. Book some time in, have a free chat with the team, and we'll be able to point you in the right direction when it comes to what you need to do to get your EPCs up to the right level when it comes to financing, how might you finance it, and what's the most cost-effective way of doing that. In this piece, I want to talk about bridging finance. It's been really the growth area for 2022, and I don't see any of that changing this current year. Demand seems to be increasing. Now, this is a market that's getting more and more competitive. So there really is a misnomer that I want to banish this bit of hearsay that bridging finance is expensive. that is nonsense. As I've said here on my bullet point, the third one down, that interest rates start actually below 0.5% per month. Now, here's where we need to be comparing apples with apples. Because when you think about mortgage rates at 5, 6, and 7%, and I'm quoting 0.5% a month, well, how do you correlate that? So the reason it's done it is at 0.5% a month is because bridging finance you may only have for a few months. So hence the lenders quote interest rates in this manner. But a 0.5% probably correlates to around somewhere between 7 and 8%. Sorry, I didn't do the exact maths. But roughly speaking, if you had your bridging finance for a whole year, probably unlikely, then you'd be paying about 7 to 8%. So it's at the top end of a typical buy-to-let mortgage rate. Now, I do want to put a caveat in that this is the starting point. So, do bear in mind that interest rates and bridging finance can increase. So, but there's a lot of advantages with bridging finances, a lot of benefits to it. If you've never had it before, that once you get your bridging finance, you don't pay the interest every month. The lender understands that you're buying a property that is highly unlikely to be income producing. So there's no real mechanism, you've no real money to pay the finance on it. So the bridging finance company says, we get that, we'll charge the interest, we'll calculate it, but we'll put it to one side. And that's the definition of rolling it up, and essentially give you the bill at the end when you're going to pay the bridging finance off. So depending on what your exit is, are you going to sell the property at the end, or are you going to put it into a long-term buy-to-let mortgage, and then you pay off the capital plus the interest at that point? So there's no impact on the cash flow. You can have it up to 2 years. So that is a big project, but it can be anything from 1 month to up to 2 years long. And usually there's about a 50k minimum lend. So, if it's really is a small project and you only want 20, 30k, then maybe bridging finance is not the right tool for that particular job. But why would you want bridging finance? Well, I just want to give you a few ideas on what I see in my brokerage, how landlords are using bridging finance to make more money. And as I said a little earlier, that bridging finance, it really is getting more in demand. I think as the landlord market now is getting more savvy, there's more education out there. You guys are more mature in your thinking, in your experience, and clearly you're looking for more ways to make more profit and to increase your margins. Then I'm seeing that your landlords are starting to look at other maybe projects that you might have given a bit of a wide berth to in the past, but now like I say, you've got the confidence to take these on. And these are just a few examples that we're seeing in our office. So maybe you're looking to buy a property, but it's not actually mortgageable at the point of purchase, meaning it's not lettable from the day you get the keys, because that's pretty much the definition to get a normal traditional buy-to-let mortgage, that property, other than a coat of paint and new carpets, it's got to be good to go, ready to be let, and there's a rental income coming in that's going to pay the finance. If that's not the case, it needs more than cosmetic work. It needs, let's say there's no kitchen in it, there's no heating in it, there's a hole in the roof, it's not watertight, it's not been lived in for years, then this is where bridging is perfect to allow you to buy it at a really good price and then get that work done maybe in a few weeks or a couple of months, and then pay the bridging off. And if you're going to keep that and add it to your portfolio, then get a normal mortgage on it. Perhaps you are looking to sell a property that's going to finance this purchase, but there's delays in the sale of your property. Again, perfect for bridging to come in, give you the money to allow you to purchase it, secure that fantastic property at a great price, and then when your property does sell, maybe a few months later down the line, you can pay the bridging off there. Auction purchases, Again, we're seeing more and more demand from your landlords that are now looking further afield. Again, you wouldn't have looked at auction houses previously. Now seeing more of you landlords looking at auction houses to buy the next property. And because of the nature of how auctions work, not the modern style of auctions that do lend themselves to getting what I would call normal buy-to-let mortgages, but the traditional where at the hammer you have to exchange contracts and you've maybe got 14 to 28 days, then again, bridging finance can be the mechanism to allow you to secure that property. Last two, the development. So again, if you're buying something that needs significant work, we have a number of our landlords that are buying, for example, something that needs structural work. You're buying something that was a buy-to-let, and now you're going to convert it to a HMO, or you're going to put an extension on there. It's going to go from a 3 to a 5, 4 to a 6 bedroom property. It might be that you're adding more living space. You might be converting the attic, the basement. Anything that requires significant works, then it might be difficult to get a traditional buy-to-let mortgage at the point of purchase. Brilliant, get the bridging in for the months, you do the maths. We as brokers will give you all the finances. You know that then you're building that cost into your costing mechanism. You know that you've still got the profit in there. Then why wouldn't you do it? The last one, again, that we're seeing more and more of, probably on a weekly basis now, is you landlords that are buying where there's a conversion required. And in this context, I've said here as an example, commercial to residential. So a couple of examples might be, as we know, a lot of the high streets, retail with online shopping being more prevalent. Of course, there's a lot of retail shops going out of business. So there's a lot of asset here in the towns and cities that are under permitted development now are allowed to convert to residential dwellings. So we're seeing a lot more landlords come to us with that type of project. Or equally on the hold-to-let front, we've got landlords that are buying care homes, guest house, B&Bs, that type of commercial. And again, there's a conversion period to bring it into fit for purpose for holiday lets. And there's also highly likely to be planning changes, as there is in my previous example. And when that's the case, it can be, not always, but it can be very difficult to get a long-term mortgage at the point of purchase. So again, two-stop strategy, get your bridging in place and then move across to a long-term finance. So bridging can be a fantastic vehicle to allow you to get into more properties that have got bigger profit margins, which means you can still be making money out of property in 2023. If you want to talk to us about anything to do with bridging, there'll be a link to our diary. Do book on at your convenience. We are available through the days, through the evening. Book a slot for 30 minutes and we'll be able to give you our expertise and time on whatever scenario or project you're looking to do, and we'll be obviously delighted to help. In this piece, I want to talk about serious illness cover. Now, traditionally, this has been known as critical illness, but it's an improvement on that. Let me explain. Critical illness cover has been around for about 40 years. And it's a defined list of illnesses. Now, the most obvious illnesses on there would be heart attack, stroke, and cancer. There's a longer list, but by a country mile, those three very serious conditions are at the top of the list and where probably 90% of claims come from. Now, what you might not know is behind those headlines, cancer, heart attack, stroke, and the rest, there's a definition, a very specific definition of what that illness means. So let's say you have a £100,000 of critical illness cover and you're diagnosed with cancer. The insurer checks the definition behind that headline of cancer. And there's just one quite severe, strict definition of what that means. So then the question from the insurer is, does your illness, does your cancer, whatever that happens to be, meet the severity for the insurer's policy? And it's a black and white answer. They'll either pay you £100,000 or they pay you zero. It's as simple as that. So where critical illness has evolved, and we're working with an insurer, which is why I really want to highlight it, because I think it's really an exciting development in this field, is that this insurer turns it on its head and recognizes, if we keep with the cancer example, that of course there's different levels of severity. So if you approach this new, more innovative insurer, they say, okay, you've got cancer, right? Let's deal with it. Let's get a copy of your medical report. Let's see the severity of it. And depending on the severity, then that 100K might pay out £25,000, might pay out £50,000, might pay out £75,000. You get my point? It'll pay out a proportion depending on and of course, at the more severe, here's your £100,000 because you need it then to deal with life and get on with things. Let's take the example. Let's say it's a form of skin cancer. It's not life-threatening, but it is still severe. It is malignant. You've had to have an operation. Maybe you've had time off work. And so this insurer says, you know what, that meets the definition for 50% payout. So there's £50,000, and that allows you to, manage your finances until you're back on your feet and back working. There's still £50,000 in the pot. So unlike traditional critical illness policies, where assuming you can claim, it pays you that the 100K, that's it, the policy ends, there's no more cover. With this case, there's still £50,000 in the kitty. So if you are really unfortunate and there's any sort of serious illness claim in the future, there's still another £50,000 to call on. That seems really fair to me. And it almost seems common sense. In addition to that, the number of conditions, the traditional cover is called critical illness, and there's anything up to maybe 70 conditions on the list. With serious illness cover, the one that I'm really excited to share with you today, there's around 180 different definitions of serious illness cover, because they take it down a notch. It's not just life-threatening stuff that you want covered, it takes it down to an additional level. So there's more chances that you're able to claim from this type of cover. What I also like is that this insurer, this is really sort of clever, they recognize that it makes sense for them to incentivize you to keep fit and healthy. Because if you keep fit and healthy, you're less likely to claim. They're not stupid. Of course, they'd rather you didn't claim. So it's better for them to reward you to keep fit and healthy and give away a bit more money up front so that there's less claims further down the line. You keep fit, then they're less likely to have to pay out. So what do they do here? Well, if you demonstrate that you can keep fit, go to the gym, etc., and again, everything's digitized, it collects that data on your Fitbits or your smartwatches. That data is collected. You can then upload that information, and the insurance company then sees that you are putting the effort in, and they reward you by reducing your premiums. Great reward, win-win all round. In addition to that, you can earn additional rewards. Now, I'm not going to be definitive and go through the whole list, but just as an example, they'll give out free Apple Watches, free Amazon Prime membership, free drinks at Cafe Nero, 50% off gym memberships, up to 75% off spa breaks, and there's a whole raft of other benefits that the insurer will offer when you are keeping fit. So they're dangling a really big carrot here. So if that is your sort of lifestyle anyway, that you like to keep fit, you do a bit of running, maybe you do park runs, or you go to the gym, or something that gets recorded, then it's playing into your hands already. You know, you may not have to change your habits or your lifestyles very much at all, but you'll get all these additional rewards. And that's why I wanted to just spend 5 minutes promoting it this afternoon. So if this resonates with you at all, if you've got the traditional critical illness cover, then it might be worth having a chat. If you've never thought about it in the past, but thought, well, maybe it's something I need to look at, then look, have a chat with the team. There's a link at the end of this piece to book some time in with the team, with our protection advisor, Yvonne. She'd be delighted to just send you a bit more information to expand on what I've talked about this afternoon, so you really get your head around what it is and whether it's something that's right for you. And again, we'd be delighted to advise. So this is the link to our diary. There's obviously our phone number and website as well, but do take a screenshot or a picture of this page if you want to do it at a later date, and type that into your browser, and that'll take you to our diary system where you can get a free, no obligation appointment with one of the team. As I say, we do evening slots as well, so please book some time in. And here's a quick reminder of all the services that we offer as a company. I won't go through them, but you get the idea. Everything to do with bricks and mortar, we're again delighted to advise where we can. If you've stayed with us to the end, thank you so much for watching this month's January update. And as always, invest with knowledge, invest with confidence, and I'll see you on the February update. Bye.